Good afternoon. Welcome to the Farm Finance Tools to Help You Manage Risk webinar. This event is a co-production of California FarmLink and CCOF with support from the USDA's Risk Management Agency. We're very excited to have you here today. We have a great presenter who's going to be speaking about cash flow management to manage financial risk, how to use farm balance sheets and income statements to manage debt, business structures and their implications for debt and building equity, the basics of credit scores and how to improve or establish credit history, different types of agricultural loans and how a loan might work for you, and the benefits of diversification. My name is Jessica Parr, and I am the Foundation Program Manager at CCOF, California Certified Organic Farmers. CCOF is a nonprofit organization that advances organic agriculture for a healthy world through organic certification, education, advocacy, and promotion. And we envision a world where organic is the norm. Very excited to have you all here today with us. We're excited to have Frederick Smith from California FarmLink to talk about farm financing. You'll notice that this is a shift from our advertised speaker, Brett Malone, and I will introduce Frederick prior to the presentation. But before we get started, we wanted to go over how to participate today, just in case this is the first time that you've ever used GoToWebinar. Here we're looking at an example of the GoToWebinar attendee interface, which is made up of two parts. The viewer window on the left, which allows you to see everything that the presenter will share on their screen, and the control panel on the right. Within that control panel is how you can participate in today's event, so let's look at that. By clicking the orange arrow, you can open and close your panel. From the View menu, you can also set the control panel not to auto-hide when inactive if you prefer to keep it always open. The audio pane provides audio information. By default, you've joined the webinar via mic and speakers. Click the audio setup to select your computer speaker or headset device. If you prefer, you can join the audio via teleconference by selecting Use Telephone, and the dial-in information will be displayed. During the presentation, you'll have the ability to send questions to our webinar staff through the Questions pane. Simply type in your question and click Send. And throughout the presentation, we'll do question and answer sessions, and hopefully we'll have an engaging dialogue. We wanted to do a quick check of the questions pane, so please use the question and answer function of the control panel and tell us how many years have you been farming, where is your farm located, what are you producing, and what do you want to learn today. Thanks so much for taking the time to test the system, and we'll get to your answers later in the program. We're hoping to have a very interactive session today, so please feel free to write in questions as they come up, and we'll write them down and get them answered as we go along. Without further ado, it's my great pleasure to introduce Frederick Smith, the North Coast Program Coordinator for California FarmLink. Frederick grew up in New York City, spending much of his 20s working in wilderness education. After earning a Master's of Science degree in Environmental Studies at the University of Montana, he worked in wildlife conservation, which led him to his role as the Executive Director of the Environmental Action Committee of West Marin. Frederick then attended business school at the University of California, Davis Graduate School of Management, where he focused on sustainable agriculture and rural economic development, and he earned his Master's in Business Administration in 2012. Frederick joined the California FarmLink team in 2014, and as the North Coast Program Coordinator, he provides loan and land technical assistance, which includes developing leases, providing financial information and assistance, packaging loan applications, and seeking out new farmland opportunities. Thank you so much, Frederick. I'm going to hand it over to you.
Awesome. Thanks for having me. I'm really excited. How many people do we have in the audience today?
We have several dozen people in the audience.
Beautiful. Great. Wonderful. I'm so excited to have all you out there. I really love sharing how to improve your financial management skills and all the other types of technical assistance that California FarmLink can provide. Just to give you a quick kind of synopsis of how the webinar is going to go, I'm going to start out with a quick introduction to FarmLink and its services. Then we're going to talk about financial statements in part through a narrative called Rick's Farm, which I created to help go through the process of how the different statements are used. Then we're going to talk a bit about the benefits of farm diversification. Fourth, we'll talk about credit and credit building. then a little bit of discussion about different legal structures, and then finally we'll finish off with talking about different types of agricultural loans that might work for you. So California Farm Link was formed in 1999. We're a nonprofit. We were originally formed to work on succession planning to help the current generation of farmers pass their land and businesses on to the next generation. We worked on a number of different great programs over the years, but in the last 4 or 5 years we've really honed in on the 2 biggest challenges facing the next generation of farmers, and that is access to land and access to capital. We have our main office is based in Santa Cruz. We also have our main loan office down in Watsonville. We, in addition to that, have regional offices in Sacramento and in Petaluma, covering the North Coast. So the Access to Land program has 3 main components. The first is our farmland listings database, where landowners can list properties for lease and or sale, and farmers with at least 2 years of commercial farming experience can contact landowners directly. We say 2 years because we found that that's a good level of experience to ensure that a farmer has the skills and experience necessary to start their own farm and be successful, and that's really helped show a good, we've been able to demonstrate a good record of success bringing landowners and farmers together on that. Second of all is our land tenure agreements. We are grant funded to facilitate and help develop and negotiate lease agreements between landowners and farmers. Whether or not you find the linking through our database, we are grant funded to help you develop leases for free. So we will sit down with both parties, discuss each party's major concerns, negotiate out the finer points, develop a draft lease, bring it back to you, and then get something to 95% point. And why I say 95% is that we are not lawyers, so we still encourage you to have a lawyer look at it at the end to make sure it protects your interests. That said, all of our clauses have been vetted by Stanford Law Clinic, and we attempt to have all of our leases reviewed by a lawyer, but that doesn't mean that you shouldn't have a lawyer looking at it too. Third is our farm succession planning, and as I've mentioned, FarmLink started out looking around succession planning. We are engaging in a new big project called the Agrarian Elders Project, and it's a long-term initiative to develop farmland and business succession services to support established farmers who are transitioning their businesses to new farmers, and for young farmers to continue those farms and harness the wisdom that has been gained from the previous generation. If you happen to know of any retiring farmers or people who are reaching retirement age who might be interested to participate in such a program, please contact me at Frederick, that's F-R-E-D-E-R-I-C-K, at cafarmlink.org. Our Access to Capital campaign has 2 primary components. One is our overall technical assistance. We can help you learn how to build your financial structures. We can help you in preparing for financing, looking at your credit scores and how to improve your credit scores, and also to give you advice on all the different loan opportunities and other types of financing opportunities that might be out there. We also have a huge list of resources and referrals where we can connect you with experts who can help you take your business to the next level. In addition to that, California FarmLink became a Community Development Financial Institution, a CDFI, in 2013, and we are a direct lender. CDFI is a special designation from the federal government that says that we are there to help underserved populations and those in need. And we really focus on trying to help underserved populations that might not otherwise have access to loans. For example, minority farmers, beginning farmers, and a lot of diversified and direct farmers that might not need the loan sizes or might have specific needs as far as loans. We provide loans of $2,000 to $650,000. We do 1-year operating production loans and 1 to 7-year long equipment infrastructure loans at 7% interest, fixed interest, with a 2% origination fee. We also started a farmland mortgage product last spring, and we do farmland mortgages of up to $650,000, up to 30 years, usually somewhere between 5 to 6% fixed interest. If your loan needs for buying land happen to be greater than $650,000, we also work directly with the Farm Service Agency and with other lenders to help package a set of loans and financing to help you get long-term ownership of land. Financial management. Financial management is very, very important to help really empower yourself to plan for the future and to grow your business in a way where you have the knowledge you need to make the right decisions. If there's anything that I've learned about financial management and farming is that the farmers who figure out their financial management systems are the ones that are really successful. If you don't know how to do a cash flow analysis to look at whether or not you can afford to buy a new tractor, if you can't look at your season and see where you might have gaps in funding you need to fill, or if you're trying to grow your business and don't know if investing in a new crop is the right way to go, if you don't have those financial management tools, then you're throwing darts against the wall to see if something sticks, and that's not necessarily the best way to run a business. So I really encourage you to learn to become informed and to be more active in your financial management. A few quick resources before I get moving that I encourage you to take notes on if you have, just to write them down to help take you to the next level after we have this presentation. One is QuickBooks. A lot of farmers I know use QuickBooks. You've probably heard it's a very common small business management program that you can do online or that you can download on your computer. And it's a great way to be able to track your expenses in an organized way, while also linking bank accounts. You can build in accounts payable and accounts receivable, which we'll talk about in a minute, and all the different accounts to really, and actually will also help you generate reports if you need to. Second is the Small Business Development Center, SBDC. There are small business development centers all around the state of California, and there are probably some other business extension services like it in other states. Basically, an SBDC is there to help you start and grow your business, and they can provide free advising services in a whole host of different areas, including marketing, startup costs, as well as figuring out your financials. And so they can actually help you to set up your systems on QuickBooks or to help you set up systems in Excel to help you manage your finances and plan for the future, and then provide you with ongoing advising services over the years to help you grow your business. Third I'll mention is the Organic Farmer's Business Handbook by Richard Wiswall. I know a number of farmers who have used this handbook to become much more successful and to be really empowered in how to manage their finances and plan for the future. So I highly encourage you to check out this book. It's got tons of great resources and all kinds of different things, so many of which we won't even have time to get into in this presentation in the short time that we have. But I highly encourage you to check it out. So there are three main financial statements: the income statement, the cash flow statement, and the balance sheet. And we'll get into more detail on each of these in a minute. But just to give you a quick sense of it, the income statement measures a company's operating financial performance over time. It's overall revenues or sales that are coming in, its expenses or costs, and to look at those profits and losses over a specific period of time, usually over a month or a business quarter or over a year, and also sometimes they forecast out. The next is the cash flow statement. The cash flow statement is concerned with the actual flow of cash in and out of the business. And to ask you, why is that different from the income statement? Well, the income statement and the balance sheet follow an accounting system that is widely used in the United States called accrual-based accounting, ACCRUAL. And accrual-based accounting means that if a service has been rendered and you expect that money is going to be paid off eventually, like any business would, then you already record it. Cash flow, on the other hand, is the actual cash going in and out. So, for example, in an income statement, if you have sold vegetables to a grocery and they haven't paid you yet, it will show up as paid on the income statement, but on the cash flow statement it won't. And so there's different reasons for having the two different statements, and we'll get into that later, but this gives you a sense of it. And then you have the balance sheet, and the balance sheet is a business's financial situation at one moment in time. So on December 31st, 2015, this is the financial health of the business. And the balance sheet is a great way. There's a lot of different cool ways to analyze balance sheets to be able to look at the overall financial health of your farm. So just a quick glossary of terms so people understand terms that get tossed around a lot. Cost of goods sold, or COGS, is the direct cost attributable to the production of the goods sold by a company. So in the case of a farm, if you're growing tomatoes, the cost of goods sold would include any starter plants you buy or seeds that you buy, any kind of fertilizer that goes in the ground to make that product grow more, any labor that goes into planting, weeding, harvesting, and preparing that product for sale. Then you have sales general administrative, or SGA, which is all the other expenses other than cost of goods sold. So, your lease payments, utilities, any money you choose to spend on marketing and selling your product, any professional fees for lawyers or accountants, you choose to pay yourself a salary, those types of things. Then we have collateral. And collateral is something that's pledged as security for a loan repayment. And it's forfeited if you go into default. And so the way it works is, for example, you get a loan for a tractor. If you get a loan for a tractor and you stop making payments, then the lender then has the right to take the tractor, which is the collateral, and repossess that to get back the rest of the loan cost. Seasonality is another term I just want to bring up. And seasonality, both in terms of business and loan repayment. If you're a retailer, most of your income comes in from Thanksgiving through New Year's. If you're a farmer, most of your income comes in from June through October. And so there's seasonality in the sense that there's certain seasons when you have more money coming in, and there's certain seasons when you have more money going out. And different industries have similar seasonality patterns in terms of their cycles year to year. And so that's what we mean by seasonality. In addition to that, a number of ag lenders will build seasonality into your loan payments. So they will have you only pay interest on your loans during months when you're not generating any money. Then you can pay all the principal for the year during the months when you are during harvest season. And this ensures that you always have cash flow, meaning you always have working capital or cash flow in the bank going in and out so that you never actually run out of money. You always have a cushion. Lastly, just profit and loss. It's a term that gets tossed around a lot, P&Ls. All that really is just common terms for what an income statement is. So that's all it is, interchangeable. I have a tendency to say P&L a lot. I will attempt to enunciate full words for the sake of the webinar, but I really want to make sure that people understand that. So the balance sheet follows an algebraic equation that has been used for a long time, but it's interchangeable. Assets equal liability plus owner's equity. And due to an old system when they used to do accounting by hand called double entry accounting, much like algebra, if you remember from grade school math, anything that happens to one side of the equation has to happen to the other side of the equation for them to equal out. And the same goes for the balance sheet. So to remind you, a balance sheet is a business financial situation at one moment in time. It's financial health, basically. And on the asset side is the left side, and that's any useful or valuable things the farm owns. That includes cash, that includes tractors and other equipment you might have, accounts receivable, which is, as I mentioned, when you have, for example, sold vegetables to a grocery store and they haven't paid you yet. Well, you expect they're going to pay you. So in the end, that is still an asset that you have at your disposal. On the other side, we have liabilities, and that's people or businesses that the farm owes money to. So in other words, things you borrowed in order to grow your business. And that can include credit cards, accounts payable, which is the opposite of accounts receivable. Accounts payable is, for example, let's say you have a contractor you work with who provides you fertilizer during the winter time to amend your soil to prepare for the season. And you have a good relationship with him, and so he says, well, you don't have to pay me until after harvest season because I know you don't have a lot of money right now. Well, that's accounts payable. He's provided you with a service, but you haven't paid him yet. And so all of those types of things, including long-term debt, go under liabilities. And then owner's equity is, from the outside world's perspective, what is the value of the farm? And so if you think about changing this algebraic equation around, your owner's equity is equal to the assets that you have, the useful, valuable things you own, minus the things you owe. So this is an example of a balance sheet. You see on the left side, we've got cash, We've got accounts receivable, like I mentioned. We have vehicles, equipment. Another thing to count as a farmer is inventory, and crops in the ground counts as inventory. Once you've planted it, you have inventory in the ground that will later be sold, and that is an asset because that is a thing that you own that is going to be used in the future to generate cash. On the other side, we have our liabilities. We have the accounts payable I talked about, credit card debt, you might have some loans, and you'll notice that assets on one side equals liabilities and owner's equity on the other.
All right, so we're going to pause here and take a minute to answer some questions, and also take a moment for people to have your brains turn on a little bit. We want to break this up. So if you could write into the question panes, what are the assets currently of your business? And you could just kind of write in a couple of descriptive words so we could start to get a kind of group brainstorm going about what assets might look like for your business. Frederick, that was a really good start to your presentation. We want to go back to the intro questions that we asked. We just so you have more of a sense of who's on the line. We have people who have been farming for between 1 and 6 years, and then we have some folks who are still in the planning phases of their businesses. So they're just kind of ramping up. I'd like to say good on you, everybody in the planning phases for being on the webinar before you start everything, before you jump in. We have people, as far as where they are, locations, most folks are in California, and we also have some East Coast representatives, including Maryland. And folks are producing guinea hogs, bees, chickens, and a variety of different fruits and vegetables and flowers. And what people want to learn most, the thing that people answered the most was they want to learn more about financing and building credit. And then we had one question come in. Somebody wanted you to repeat the name of the book that you recommended. It was like the Organic
Oh, yeah,
Farmers.
sure. That's the Organic Farmers Business Handbook by Richard Wisball.
Right. And just so folks know, along with the recording of the webinar today, in your email we will send a list of all of the different recommendations that Frederick has. So for those of you guys who are furiously taking notes, that's excellent, but we'll also send you an email with kind of a recap of the summary of things. So just for you, Frederick, the assets that people have that they've written in so far: beehives, hogs, chickens, buildings, inventory. Can you talk a little bit about how inventory or buildings can be assets?
Well, a building is a structure that you put that has a value attached to it, and therefore it's something that you use to house livestock, for example, to store equipment, to store some inventory, for example, in a cooler you might have in the building. Whatever it might be, that the building is a useful thing that you have at your disposal. If you didn't have it, you'd have a lot less capability to generate the cash you're trying to generate.
Got it. And does land count as an asset? Most
definitely. Land is definitely an asset. And because if you think about it, if you own the land, it's certainly an asset versus a lease, which is a very different situation. By having an asset, owning the land, that is a useful tool that you have in order to generate income for your business.
And then we had a question from somebody who said that they are currently planning to purchase a farm. Would an annuity plan be considered an asset? And for those of us who don't know what an annuity plan is, can you explain that term?
Sure. An annuity plan is a plan where you basically have a certain sum of money, and then it's set up so that you get an automatic payment of equal amount over an entire term of that annuity. Sometimes it can be lifetime, sometimes it can be a certain defined period of time, and it's basically in some ways just a way to space out. It's used most often in retirement as an easy way to help people who have a chunk of money plan out how much money they're going to have throughout the rest of their lives.
Right.
So as an annuity, yeah, I mean technically if the annuity exists and it's attached to your business, or if you're a sole proprietor, which we get into later, yes, technically that is an asset.
Got it. Okay. Thank you for that. I think we should move on.
Okay, great. So your income statement. Your income statement, again, is looking at the overall company's financial performance over time, and really its operational performance. You'll notice in the income statement that there's certain things that don't exist that you might see in a cash flow statement. For example, if you actually buy a tractor, it won't show up on your income statement. The income statement is really talking about how the business operates year to year. So you have your revenue, otherwise known as sales, so all the money that you generate selling your products, minus the cost of goods sold, the COGS, which I mentioned, which is all the costs that go into producing those products, and you end up with a gross profit. And you also end up with a gross profit margin, which I'll show you in a second, which gives you a percentage of how much money you have left over to spend on the other aspects of the business. Then you subtract your sales, general, administration, or SGA costs, and you end up with a net income. And net income is all the money you have left over after operating your business that you can then spend on potentially purchasing equipment, paying taxes, paying owners, and other types of payouts that way. So this is what an income statement looks like to give you a general sense of it. This is showing you a 2014 and 15 annually, and it also shows projections for 2016. And in income statements, people often will do projections to try and plan out how much they think that their business is going to generate in income and paying costs, and then measure that against reality once it happens. I'll just point out here, I mentioned it, the gross profit margin, which is right here, basically says it's 78%. The way the equation works is it's revenue minus cost of goods sold divided by revenue, which gives you a percentage, essentially the percentage of your revenue that's left over to then spend on everything else. So in this case, in 2014, if the gross profit margin is 78%, that means that it took 22% of the revenues to produce the products, which means you have 78% left over to pay your farm insurance, for repair, to pay for your lease, to pay yourself a salary potentially, and also to have net income left over to then pay out to owners or to spend on buying equipment and those types of things. And then cash flow. We have cash flow statements, and I'll show you what one looks like in a minute. But cash flow analysis is much bigger than just cash flow statements. Yes, cash flow statements are looked at on an annual basis to be able to see, to plan out your season. You might have a crop production plan where you decide which crops you're going to grow and what the costs are going to be to produce those things and what the revenues are going to be at the end. Now imagine that on a larger scale for the whole business. So it allows you to look over the whole season and see when you might need extra money and to figure out the financing for how that's going to work, or to be able to plan out your marketing expenses for when you plan to bring in more income. Also, it's really, really important if you're thinking about a major change, like, for example, buying a piece of equipment, figuring out whether you have the money to afford to buy that equipment and not need outside financing to make it work, or potentially adding a new crop or hiring new labor. It's great to be able to do a cash flow analysis to see if you have the money now, and if not, to figure out some way to get access to that money. That can be by waiting, that could be by getting a loan, that could be by potentially doing a Kickstarter campaign. There's lots of different ways to find that funding, but you want to know ahead of time that you're going to need it, and that's what cash flow analysis can help with. So just to give you a sense of this is the basic part of a cash flow statement. This is the cash flow in part. And Rick is someone, as I mentioned, is part of the narrative we're going to talk about. We'll hear about this in a minute. What can we see about this part of the cash flow statement? Well, we know that he shows sales by channel. He doesn't show it by fruit or vegetable type. And so there's different types of cash flow statements. In this one, he's showing it by the different market channels. So CSA, farmers market, wholesale. We notice that if we look at his total sales, we notice that farmers markets make up about 2/3 of his sales for the year. So he's very dependent on farmers markets. You also notice that has money coming in every month for a CSA. That suggests to me that he has a month-to-month subscription for a CSA, and he doesn't require that everybody pay everything up front for the season. And so he's following a month-by-month type pattern. Also, we notice he has no loan disbursements during this period. We also notice that he doesn't have any off-farm jobs. We really encourage people when they look at a cash flow statement, especially if you're a sole proprietor, to build in any off-farm income and expenses. So you're looking at your whole health of your business and yourself within it. Next, we'll look at the tail end of the cash flow statement. We'll look at the cash flow out. what do we notice here? Well, we notice that if his total operating expenses in this case are $26,070, we look at these costs, it looks like the majority of his money is happening in the first part of the season, because right now we're only looking at June through December. So most of his costs are happening early in the season. We also notice that he has labor during certain parts of the year, but not during others. We also notice that he builds in his non-farm expenses, and he's allocated himself $850 for rent and $1,150 per month as his average personal expenses. Then also looking down here at the net cash flow, the cash flow here is basically all the cash flow in minus all of the total cash flow out, and basically we have it set up so the beginning balance and an ending balance. So the beginning balance plus the net cash flow equals the ending balance, which then starts up again here, and this is on a month-by-month basis. So then we know at the end of the year he's made $36,936, but his total ending balance means he has $58,000 and change in the bank. So Rick's farm. This is a fictional farm. Rick has 6 acres of mixed vegetables. He does primarily CSAs and farmers markets. He's been in operation for 5 years. This is balance sheet on May 1st, 2015. You'll notice he has $7,000 in cash. He has 350 accounts receivable, money that's owed to him for products he's already sold. He has a truck worth $10,000. He has some farm equipment. And he has $25,000 of inventory, meaning crops in the ground that he's planted since the first of the year that are waiting to be harvested later. He also owes $250 to the fertilizer. He has $750 in credit card debt. And he has a $5,000 family loan. There's no real interest rate on it, and there's no timetable for when he has to pay it back. But certainly, if it's something you owe, it's important to put that on your balance sheet. So looking towards the end of 2015, we're looking at his income statement. And what we noticed is that in 2015, he had a good year. His revenue is $63,006, and his total revenue the year before, so that's a, what, $13,000 almost increase. So he's had a good, profitable growth year, in particular through his farmers markets, but really across the boards. In addition to that, his gross profit margin is very similar, which means his costs have kind of have stayed the same. His costs to produce more goods have been at the same relative level, which seems pretty healthy. If for some reason his gross profit margin had been much lower, then we would have said, oh wow, what costs really went up that made it more difficult for him to produce the same amount of goods. But in this case, he's really steady, so that's a good sign. And then we see he also pays himself a salary. Depending on your legal structure, you can choose to pay yourself a salary or not. Since you are the owner, you get everything after net income anyway. But net income can also be taxed, depending on your legal structure. And so some people choose to build in an actual income to help pay personal expenses. If you remember on his cash flow out statement, he had built in $2,000 per month for his personal expenses. And so there you see that here in the salary he's giving himself. So just to give you a sense of how you connect the income statement and the balance sheet, what we showed you before was he had $7,000 in cash, and he had these, and this is how his balance sheet was before he started to generate income. So to see how you connect the balance sheet with the income statement, remember he had $63,006 in sales. His COGS and SGA combined was $48,245. His previous cash was $7,000, if you remember, and his inventory, he had $25,000 in inventory that he harvested during the rest of the year. So to come up with his new cash on his balance sheet, we look at the previous cash, we subtract that by the inventory, because that was the inventory pulled out of the ground. We add in the $63,006 in new cash that he's generated. And then I also make a couple adjustments, and certainly income statements are more based on accrual accounting, and yet at the end of the year you need to make some cash adjustments. And so I do make a cash adjustment for the fact that he did receive the $350 from the grocery, and he did pay off the $250 for the fertilizer that he owed. In addition, we look at earnings, which are overall the sales minus the expenses. So now we go to the balance sheet for the end of the year, and we see, okay, so like we did the equation, we saw 45,106 in new cash, and there's the new cash. The accounts receivable goes to 0, the accounts payable goes to 0. And the inventory is gone because he's sold everything for the season already. He's also made $14,761 in earnings. He's paid off a few things that are outside of his straight cash, and so it's not exactly an increase of $14,761, but it's pretty close. But back in October, before we got to December 31st, since Rick's planning ahead, Rick has this used tractor that must have parts from like 30 different tractors on it. I mean, it looks like an amazing multicolored experiment, and it keeps breaking down all the time, and he's really concerned. He really wants to expand his farm. He's potentially going to have more lease acreage, and he really wants to expand his operation. So he really thinks he needs to buy a new tractor. He'd also like to build out some greenhouse space so that he can grow the length of his season, and potentially also get a cooler or some money towards a cooler he needs to help extend the shelf life of his products. And he thinks he's going to need about $30,000 to do that in 2016. So he does a cash flow analysis, and he looks at, shows the beginning of 2016. He has a cash flow analysis building in the $22,000 as a new cost in January, greenhouse in February, and cooler in March. And what he realizes is, oh, he's going to run out of money if he does this before he actually starts generating enough money to offset the costs. So he needs to figure out some way to finance this in order to make it happen. Now, there's lots of ways of doing that. In this case, he goes out to a lender and he finds he gets a lender to agree to do a $22,000 5-year term loan at 7% fixed interest. And so he then adds in that $22,000 and realizes, okay, wow, there's $22,000 extra that I receive during this period. And that basically will offset the cost of the tractor, which then shows that his ending balance, he doesn't go into the red anymore. Now, one could say maybe he didn't need all $22,000 as a loan. He certainly has a lot of extra cash here, which is not that far off. If you remember correctly, he was only a couple $1,000s in the red prior to getting the loan. But Rick really believes that you can have variable years in farming, and it's good to have a cushion around, especially when you're growing your business. It's good to make sure that you always have enough cash in the bank to do what you want and to deal with unforeseen circumstances. So he receives the loan, and so you notice the big changes are he receives $22,000 in cash, but that must be matched correspondingly on the balance sheet on the other side, and he has the $22,000 new loan. So he has $22,000 new in liabilities. He also, during that couple weeks, has paid off his credit card, and so that's also factored in. But nonetheless, the main thing to notice is that his cash and his liabilities are $22,000 each. But he hasn't bought the tractor yet, so how does that work? Well, let's look back at the end of the season. And so we have the 45,106, accounts receivable 0, everything else is 0. Switch over again to the 15th. He has the $22,000 in cash and liability. He's paid off the credit card, and then he buys the tractor. And so then what happens is you have a shift here. Technically, the total assets number doesn't change. All you have instead, in the case of the purchase, is you have $22,000 less in cash and $22,000 more in equipment. In addition to that, there's a small reduction in owner's equity because he still has to pay his January expenses, and this is his financial situation on January 31st, 2016, and he has $1,885 in expenses. So there's also an $1,885 reduction in cash and an $1,885 reduction in his owner's equity, and so which is a slight reduction in what's considered the value of the farm, looking at his total assets versus liabilities. So looking at, Rick forecasted out making over $70,000 for 2016, and unfortunately, Rick has a really hard year. He had a really good year in 2015. He was really optimistic. Things were going great. And then his prize tomatoes had some insect issues. And on top of that, it's generally a drought year, and he had some problems. And he ended up suffering a 70% loss of revenue. And so that was a major hit to him. You'll notice his gross profit margin went down, means he actually had a lot less money after that to pay the rest of his expenses. So he would normally end up with a loss on his net income. Now, certainly, if we think back to his cash flow statement when he was thinking about whether or not to get the tractor, and we were saying, oh, well, he's only a couple $1,000s off on the loan, by getting a larger loan during that time of preparing, building in a cushion, he was able to prevent, even if he suffered an income loss here, to still have enough money in order to operate his farm. But fortunately, this is not, while this is the actual operational net income that he incurred, he was fortunately also got whole farm revenue protection. And whole farm revenue protection was started offering in 2015. He jumped on it immediately and signed up for it at the beginning of 2016. And it's a new insurance product that is really created for diversified and organic market-based farmers. It is an umbrella policy that covers all your crops and livestock that are grown on your farm. It's available in every state and every county. You have the ability to insure organic crops at organic prices, which is uncommon in a lot of other insurance products. And it actually rewards diversification. And you can get up to 85% coverage if you have 3+ commodities. USDA has also provided very large subsidies to make getting this coverage very affordable. So it's a really, really great potential policy that you can use. And let me just explain the way coverage works. So imagine you have car insurance. When you have car insurance, let's say you have a $500 liability for collision. So that means for the first $500 you pay for it, and then everything after the $500 the insurance company pays for. Coverage works the same way in whole farm revenue protection. So if you have 85% coverage, you incur the first, and you buy this product, you incur the first 15% of the loss yourself, but then everything after that is actually reimbursed to you as an indemnity payment that you get after you file your taxes at the end of the year. So let's walk through the system. First of all, as eligibility, you must be a U.S. citizen or resident. You need to have at least 2 crops. You need to have at least 5 years of Schedule X tax returns. If you're a beginning farmer, which in this case is actually defined as anything less than 10 years, so pretty much everyone listening here who's a farmer, then you need 3 years of Schedule F tax returns. And these are basically used to figure out and normalize like an average revenue rate that you might be generating on your farm to help the insurance agent figure out what your revenue will probably be for the next years coming up, what your costs are, and those types of figures. Whole farm revenue protection covers up to $8.5 million in insurable revenue. And also, very importantly for you, for the aggregators out there, those of you who grow products on your farm but also buy products from other farms, then for resale, up to 50% of the stuff that you insure for revenue can come from other farms. So it's important to remember. So because of that, Rick had gotten a $75,000 of approved revenue for 2016. As you may recall, he only made $63,000 in 2015. But Rick was able to show to his insurance agent that he was taking on more land, he had a new tractor, he was building in a greenhouse and a cooler, he was hiring more labor, and then that meant that he was really expanding. And so the insurance agent agreed with him that $75,000 seemed like a good level. And he purchased 85% coverage level. So that meant that no matter what happened, if he is insured, guaranteed to have $63,750 in revenue, which means if you consider what he made last year, he's actually insured to make more money than he made last year. Now, in reality, on his Schedule F, when he filed it on January 2nd, he only made $52,925. But he knew that there'd be a little lag time before he got the indemnity payment from the insurance agent, so he made sure to file his Schedule F right after the first of the year. So then by March 2nd, he actually received a payment for $10,825. So since he knew he had crop insurance and he knew this was probably likely a reality, he adjusted his income statement on January 2nd when he filed his taxes, once he figured out his Schedule F, and built in the indemnity payment into his overall revenue. He was able to say, since I know that I'm going to get this, I actually have a positive net income of $5,522, not a negative 5,302. So this is a great way to show how whole farm revenue protection can help buoy your business during tough times.
And Frederick, we did have a question come in.
Yeah.
Whole farm revenue protection it's a government program, right? Like where would people go to look for information about that?
It is done through the Risk Management Agency, which is within the U.S. Department of Agriculture. And just so you're all aware, we have a whole other webinar that's happening in September that's going to be going down into depths over an hour and a half about all the little intricacies of whole farm revenue protection, how to apply for it, how to figure out all the other aspects to it.
Thank you.
So what you'll see is at the end of 2016, how it reflects the balance sheet, his cash is a little lower. He has all the equipment that he purchased. So he has a $22,000 tractor, $5,000 greenhouse, $3,000 cooler, plus the equipment that he already had there. He has no, in addition to that, he has no crops or inventory in the ground. He sold all of that. His new loan has been partially paid off, and that's because he was required to pay back some of the principal and interest immediately at the time he got the loan. So over the period of the first year, he paid off $4,400 of the principal and also some in interest. So overall, because of whole farm revenue protection in part, his earnings were positive $5,522, which means his owner's equity actually went up a little bit despite having a hard year. So balance sheet ratio analysis is something else that I want to discuss. And like I said, the balance sheet shows the health of the farm at a specific moment in time. And balance sheet ratio analysis is pretty cool to look into. You can go way down the rabbit hole on this kind of stuff because there's so many different kinds of things you can look at, but certainly over time there have become different industry standards for what a good ratio is to sort of analyze the overall health of your business. And so ratio analysis is one great way to do that. So for example, your current ratio, which is all your current assets divided by your current liabilities. In the sake of a farm, 1.7 is relatively strong. That basically says that you have 70%, well, relative sense that you have an extra 70% of assets over that of what your revenues are. And so 170 to 100%, which means that you have a lot more stuff that you own that you have to create money than that you owe to manage your business. And so that's a really healthy thing to look at. In addition to that, debt service coverage ratio is one that lenders look at a lot. And the reason that is because debt service coverage ratio is our way as lenders to look at whether or not on a year-by-year basis you're going to have enough money to cover the debt that you have to pay each year. And so in the case of like a debt service coverage ratio, we're looking at how much principal and interest combined do you have that you have to pay, and what was your net income. And so when we look at the Rick's Farm, for example, we noticed that and also I was going to point out that in the case of this balance sheet, what I did was I broke out the current assets and the fixed assets so you could look at them in different senses. Now remember, current assets and current liabilities are assets and liabilities you expect to use during the year, whereas long-term liabilities and fixed assets are much more longer-term things that you own or that you owe. And so what we noticed is that in 2015, Rick had an amazing debt coverage ratio because he had almost no debt. He didn't have any really obligation to pay other than maybe some credit card bills. And so he has a massive debt to coverage ratio. But then in 2016, even though he ends up okay, still his net income was relatively low versus the debt that he owed. And his ratio is actually 0.93, which, as we know from looking at this overall, is not good. It makes it much more vulnerable. And so that makes lenders say to themselves, okay, we need to be more watchful and monitor Rick a little bit more to make sure that he's going to have the cash he needs in the long-term sense to be successful. And if so, we should just watch out, because certainly our main goal is to make sure that you're successful and to make sure that you can repay your debt. And so we want to make sure that we find a way to help Rick get back towards the 140% at least, so that he's in a healthier state. So like I said, these are just a couple of the different calculations that you can do. There's all kinds of different ones, and there are certain that are really important to look at depending on the type of business that you're in. I highly encourage you to dive into this more. Grab the Organic Farmers Business Handbook, look up some of these ratios online, and play with them and find out some cool ones that seem to work for you. Because each of these is one kind of measurement for looking at the health of your farm in a different way. So what we also notice is we look at his total current assets versus his current liabilities. He's actually doing really well on that level as well, which means he always seems to have more money coming in than he's paying out in terms of what he owes. So in general, he has a very good current ratio. Another good thing to look at.
All right, so we're going to take a pause and ask another question. So Rick chose to get a loan to pay for his tractor. What are the other ways he could have achieved his goals? Just creative brainstorming here, and feel free again to write your answers into the question pane. We had a couple of questions come in, Frederick. Somebody asked, how do you calculate the value of inventory or crops in the ground? Is it value that you have invested in them, or is it the value that you anticipate earning, or is it somewhere in between?
It is a cost of goods sold measure, in essence, on your balance sheet. So it's the value you're putting into the products.
It is the value you're putting into the products is how you would value the products in the ground.
Right, not the value of the sale.
Right.
Exactly.
Okay, got it. And then somebody had a question about whole farm revenue protection, and they wanted to know if it applies to greenhouses. Yes, anything that's on your farm. As long as you're a farmer and you own a farm business, whole farm revenue protection will cover anything. Okay, got it. I think we should continue, and then we'll kind of come back to what people think about ways that Rick could have gotten the money to buy his tractor. Great. So, on the taxes aspect of things, there are actually a number of things we haven't really gotten into talking about operating financial statements. And that's because they're very specific to taxes and we have limited time. One, for example, is called depreciation, which means if you purchase equipment, it has what's called depreciation. It's basically an incentive by the IRS to encourage people to buy large equipment, to really support the local economy, to support the federal economy. And so there's something called a depreciation schedule, and basically you're allowed to depreciate out or lower the value out of the large items you buy over time and use that as a tax deduction. So as a quick example with Rick, he bought the tractor for $22,000, and he follows what is pretty standard actually, a 7-year-long lifespan value for that tractor, and basically divides 22 by 7, comes up with a standard number that he then gets to deduct from his taxes each year. In addition to that, other things that are deductible can include interest payments on your debt. So the 7% interest that he was paying on the $22,000 loan can also be deducted after your net income and before taxes. There's a number of different deductions and credits out there that we don't have time to get into. But I certainly encourage you to learn more about them and to talk to a certified accountant or bookkeeper about how these things work. One other important thing to remember in terms of this is from a lender's perspective, and that is we want to make sure that you have enough money to pay your debts after all the other costs that you have in the business. On the one hand, it's advantageous if you think about it to make sure that as much money as possible spent on the business, so you minimize the amount on your bottom line that you have to pay towards taxes. On the other hand, if you minimize that too much, then lenders might not think you have any money to be able to pay back loans, so they won't give them to you. And so if you notice, Rick, for example, paid himself a $24,000 salary. Since he's a sole proprietorship, he could have just as easily waited and not built that in as far as filing his taxes, and instead just took all that money as net income. And in doing so, he can show that he has more disposable income to play with. And so how you file your taxes versus how you manage your financial statements outside of taxes are different things. And so it's important to talk to a professional who can help you with how to file your taxes. So farm diversification.
One of the basics of business is that diversification, if done correctly, is a beneficial thing. Diversified farm, which I expect most of you out there are, is one that has several different production enterprises or sources of income from different products, but there's no one that really is more than 50% of your total income. And the idea is that the benefit of that is that you minimize risk first on the downside, because the more types of crops and animals you grow, the less risk there is if a few crops have a bad year. And there's more expanded opportunity as well, because you have more ability to potentially meet customers' needs in certain areas, and also to take advantage of revenue, high revenue potential in certain key areas. And so overall, diversification can have a lot of benefits. There's a number of different kinds of diversification. Just to sort of give you a sense of how to think about it, there's sales channel diversification, farmers markets, wholesale to restaurants, wholesale to groceries, CSA, farm stand. There's a lot of different ways you can sell your products. But let's say that you're entirely dependent on farmers markets, 100%, and then we hit another recession. Well, when we have recessions, generally people spend less money at the farmers market because they have less disposable income, and they're more likely to try and find ways to buy cheap products, and they're less likely to think about the value add that local connections have. And so if you're entirely dependent on one source for sales, then you're dependent on market forces beyond your control for that one area. But imagine if you sell in 5 or 6 different sales channels. Then if you have a challenge in one, you can make sure that you have stable revenues in other ones. Horizontal diversification is another one. How many different types of raw products do you grow? How many different vegetables, fruit, pork, chickens, eggs and meat, honey? How many different individual income sources do you have from raw product? And again, the more of these that you have, if 1 or 2 of them have a bad year, or if 1 or 2 of them have a really amazing bumper year, like let's say you grow pigs and heirloom pigs just suddenly come into amazing fad this year, and suddenly people are willing to pay 30% more than they ever were before, well, you happen to have that income source. But you have other sources as well to really minimize the downside and maximize your benefit. Then you have vertical diversification, which is in addition to the raw products that you grow, what are all the value-added products and other types of things you can do on your farm that you can generate income from? You can do canned products, you can do charcuterie if you have a drying room, you can do farm dinners, you could have weddings, you could have farm stays. There's all kinds of things that are the next level up from just producing raw products that you can also do to diversify. So I've known people that have had really bad farm production years who have actually still generated a profit because they do a lot of events on their farm. And so by doing the events, that's been able to help them stay alive, even if they had bad production. But don't just diversify for its own sake, because that can be bad too. You really want to be strategic. What are your customers asking for? Are they asking for a certain type of product that doesn't exist currently in your local market that people really, really want? I think about up in Humboldt, the Humboldt County farmers markets, they only sell county-grown produce. And so that's actually a closed market where you can say what products are not being sold that I could satisfy. Or are there ways that you want to differentiate yourself in terms of the way you market yourself to differentiate yourself from other farms? And that might be a good reason to diversify. Also think about the infrastructure capacity. Is the product that you might want to grow to diversify into, do you actually have that equipment and expertise already, or are you going to need to pay to get it? And so that's important to remember. Also regulatory. If you've never done meat products before and then you suddenly decide to grow pigs, you're going to need to do a whole bunch more regulations and paperwork related to the U.S. Department of Agriculture. And so make sure to think about those things before you decide to embark in that. Most importantly, though, do a cash flow analysis. Like I said, you can look at the idea of introducing a new product onto your farm and see if the financial benefits are going to outweigh the costs. And if you do all these things when you think about diversifying, you can make smart diversification decisions that can benefit your business and its long-term viability. So, understanding credit. Credit is the ability to obtain goods and services before payment based on the trust that payment will be made in the future. It's a personal record of your debts and repayments over time, and it can, like it says, be a really big burden or a really powerful tool. Think about it in the sense that as a lender or as someone else, we want to know that we can trust that you're going to repay your loans. And if you have a low credit score, our first thought is this person doesn't know how to manage their money, or they're not very responsible with their money. And so that makes us more concerned. And don't just think about credit in terms of debt and taking on loans. The fact is that if you decide to get a credit card and you have a low credit score, you're going to get a higher interest rate, or you might get denied for a credit card. Or when you get car insurance, they look at credit scores and they factor that in terms of how much you pay for car insurance. So there's a lot of different areas where having a good credit score can really benefit you, or a bad credit score can hurt you. So this is the way the kind of breakdown of credit scores. Most people fall in the good to excellent category, but certainly, like, you never know when something can hit you that can work against you. I, for example, know a farmer who had a bunch of medical challenges a couple years ago, and he had a whole bunch of different bills, and he paid off as many as he could, and he had it all set, he thought, but he missed one, and that ended up going to collections, and that sits on your record for 7 years, and that's a long time to have a dent in your credit score, like, just because you missed one payment. And sometimes when it comes to medical issues, they're able to scrub that off your record a little earlier. But if you miss a major payment and you don't repay it in time, it will go to collections, which is a major stamp against you. But it's important to do your best to stay in the upper end. So what affects your score? Well, as you can see from the pie chart, the two biggest ones are, one, do you actually pay your bills on time? And then two, what's your capacity? And what I mean by that is, let's say you have $10,000 of potential credit from credit cards and other means, but you're only using 20% of it. That gives you a higher score. That suggests to the credit rating agencies that you're responsibly using your debt, that you keep your overall credit balances relatively low, and that you have this extra credit if you need it, but you don't use it unless you have to. But on the other hand, if you're all maxed out on your capacity, then they're going to say, wow, this person doesn't necessarily know how to manage their finances that well, and they're getting themselves in a situation where maybe they're taking on too much debt, and that will negatively affect your credit score. Other things include the length of your credit history, so how long you've been had a credit history. Also, are you looking for new credit? Every time you apply for a new credit card or any other type of credit, they do an inquiry and just check out your credit score. If you get too many inquiries in a short period of time, then that can affect your credit score negatively as well, because they think that you're shopping around too much. That kind of concerns them. So there's a lot of different things that factor into your credit score. So let's just compare it to a couple different farmers. One is a farmer has zero debt, never taken out a loan, pays for everything in cash, has no credit score, doesn't exist. Well, that doesn't help either if you're going out looking for financing. You need to be able to establish that you at least have a basic credit payment system. So what I encourage in that situation is just to get a credit card through your bank, since they already have your bank account, and just set it up to pay for your utilities through your credit card, and then set up auto pay through your bank to pay off those costs, and then just monitor the system to make sure it works, and that can help you start to build a credit payment history. Another example is farmer number 2 has major debt, has frequent late payments, has a lower credit score, which is going to make it really hard for them to get low interest credit cards in the future or to get other loans. Then farmer 3 has some debt, but always pays on time and has a long history of borrowing. They have a good credit score. So that just gives you a sense of the different kinds of options. So just to remember how to improve your credit: pay your bills on time, and if you owe money that's gone to collections, pay it off as soon as possible. Get the credit card through your bank and do that the safe way first. Keep your balances low on your credit cards, and apply for new credit only as needed. And those are the basic steps. I also personally use an online credit alert system. It's not accurate because it's called freecreditreport.com, but I pay $18 a month. But they give me alerts whenever something thinks maybe there's a missed payment or something might be going to collections. I had a bill that I thought had been paid that I had sent in by mail and it had not actually gotten there, and they gave me an alert that something was going to collections. So I was able to stop it before it got to collections. So it's it might be worth your while to have something like that. So I highly encourage you to check out Experian.com. That seems to be the easiest one that I've used, experian.com, right here. You can go to any of these and you can get your credit report and ways to improve your score.
So let's just take a minute again to kind of turn our brains on to a little question and answer session. So if folks want to write into the question box, what are the best ways to repair your credit score? What are creative ways that you could imagine repairing your credit score if you've had some issues? And then I wanted to harken back to the question that we asked earlier. We asked about how Rick could achieve his goals of buying his tractor. We did have somebody write in that they could that he could have purchased the equipment with another farmer. He could have shared its use, the expense, the maintenance costs, and yeah, that's a definite one. Were you thinking of other answers, Frederick? There where people could different ways to finance a tractor?
Well, I think it's important, if you look at his cash flow analysis, he built in both the cooler and the greenhouse and the tractor, and yet he was only a couple $1,000s off for all of them. Maybe he didn't need all three of those. He knew he needed the tractor more than anything else. So maybe he could have foregone on the greenhouse until next year, and that would have actually given him enough money to have a cushion in his bank account, and he never would have had to take a loan at all. So planning out when you make capital expenditures in terms of timing can also be really important.
Yeah, and we did have some people write in about how to repair your credit score, rather, and it's just as simple as paying your bills on time.
Yep.
That's what it comes down to.
That's the key right there. It's important to build in an ethic as a business owner to have as much credibility as possible and to be able to exemplify that through your business. And so paying your bills on time is just a vitally important thing to do.
Let us all aspire to be that good.
Yes.
All right, so let's move on. Thanks, Frederick.
So legal structures. There's a number of different legal structures out there. I really encourage you to consult with an attorney or a certified public accountant before deciding on a legal structure. I'm not going to get into every single one of these because it would take a lot of time, but I'm going to cover some major ones that are common structures that farmers tend to use. Sole proprietorship. 98% of businesses in the United States are sole proprietorships. The advantage is it's free. There's no additional paperwork. In the case of a farmer, you'll build a Schedule F into your tax return, but other than that, which actually in some ways makes it easier to understand the business part inside your personal overall tax return, but it really requires no extra work on your part, no fees, nothing. The negatives are that the owner could be liable for litigation against the business. Now, ideally, every farmer has insurance in case someone sues them related to their products or in case someone gets injured on your farm, other types of situations like that. But if your insurance isn't enough to cover it and someone decides to sue you for something, then your personal assets are liable if you're in a sole proprietorship. So if you personally own a home and then you also have your farm, if your farm gets into financial trouble, for example, and you can't pay all the bills through that, then suddenly your house could be liable for collateral. So it's important to realize that in a sole proprietorship, you can't separate out your personal from your business finances and protect your personals. Nonetheless, in most cases, farmers start out as sole proprietors because most small businesses, it's the easiest way to go and you don't have to really do anything. Certainly, we really encourage that you create a separate business checking and savings account and that you make sure to file your Schedule F as part of your tax returns because that shows that separation. But beyond that, and of course to make sure that you have farm insurance. But again, your personal assets can be liable in this situation. Partnership, if you have more than one individual, and certainly a number of farmers out there I know do go into business together to start farms. And the advantage of a partnership is you only get taxed once, meaning it's a pass-through entity, which is true of a couple different legal structures, which basically means that the business itself doesn't get taxed. It's just the partners that get taxed on their personal income tax returns. So in some ways, you're setting up a structure that basically says, I have this much ownership in the business, she has this much ownership in the business. And so that it really clearly and legally defines how profits are shared, how liabilities are managed. On the negative side, depending on the structure, it can also still expose you to some of those liabilities we talked about. Corporations, C corporations, for the most part, I'm just going to say you're not going to want to get a C corporation. This is what all publicly traded companies follow on the New York Stock Exchange, et cetera. And has limited personal liability and has options for different types of shareholder investments and things like that. But on the con side, for a farmer, you get taxed twice. You get taxed at the company level and at the shareholder level, and it just doesn't really work for farmers in general. I know one farm that does S corps, which is small. In this case, you want to have all equal owners, but in the grand scheme of things, it still requires that you follow a lot of rules and regulations that could require you to bring lawyers into the situation, and you get much more scrutiny by the IRS. So it's definitely an easier one to avoid if you can. Limited liability corporations are common because they're really flexible. It's good when there's a large ownership disparity, like one person owns the land and one person owns the business, or one person owns 20%, another person owns 70%, and someone else owns 10%. It's a great way to be able to show those different ownership percentages. It has the advantages of limited liability to have that protection, and the financial flexibility to be able to raise money through investments, and has a lot less admin and record keeping than corporations. But you do have to put together your own operating agreement as to how the company is going to operate with these different owners. For example, like some operating agreements might say that even though there's 3 of you with different ownership levels, you all get to make your decisions by democracy, which is unusual because in most cases the person with the most ownership makes all the decisions. And so there's lots of things that go into operating agreements in terms of how the LLC is managed. Also, as an LLC, you have to make it, if you don't already pay at least $800 in state tax to the State Franchise Tax Board, then you're going to have to pay that anyway. It's a minimum. So unless you're already generating that much of state income tax or state tax, I would avoid it. Nonprofits, the last one I'll mention, and this is great for educational farms, and there's certain advantages and disadvantages. It's a separate business entity from the founder, so there's actually no ownership or personal ownership in the business. The advantages are you're eligible for public and private grants, and you can get tax-deductible donations from the public, and you can use that to buy equipment and fund your business tax-free. And you also have the advantage of having limited personal liability attached to the business. So any personal assets you have are separate from the business, which means if the nonprofit has trouble, you still get to protect your own personal assets. The cons are, one, it's shared control. Just because you happen to start it doesn't mean that you have total control over what happens there. Usually there's board of directors that get set up, and they make decisions, and you might be a member of the board of directors, but you're only one vote. And so in that sense, you do lose some control, and there's no ownership. Even if there's profits, you don't get the benefit from those. In addition to that, there's public scrutiny. So anyone can walk into a nonprofit office and ask to see the finances of that organization. And that organization is required to show those finances. The nonprofit, you are open to public inspection, and you have a lot more filing requirements. This is just important to remember. Co-op is controlled and operated by the members, one member, one vote. It's great when you have lots of small producers, like you've seen milk co-ops and some others. It really helps you with bargaining power in particular. The ability to bargain for lower prices to purchase items and to sell at higher prices than one individual might be able to benefit from. It does require a lot of work in terms of managing a large organization with lots of members and what kind of decisions get made by those individuals. And also, it's also important to remember that every member gets one vote. So it doesn't matter, you might have $1 million member and a $10,000 member, but it's all one member, one vote. And you're really going to need to hire professional managers to manage the whole thing. It doesn't really work as an individual business concept.
Just as a resource, the Center for Cooperative Development here in California is a great resource if you're considering starting co-ops here in California. They have all kinds of templates. They have people to help work on your business plan with you. So the Center for Cooperative Development.
Thank you. I'm going to skip the B Corp for now. B Corp is a designation that exists. It's in addition to whatever legal structure that you decide to use. And like Fair Trade or CCOF, it's a stamp that goes onto your system that shows people that you're thinking about things other than just your financial bottom line in terms of making good decisions. I highly encourage you to check out the B Corp website and to see more of what's available. But it's not in and of itself a legal structure. So preparing for financing. Well, Rick figured out how much money he needed. He figured out why he needed it, and he decided when he needed it. And he looked for options out there to figure out the best way to get the financing he needed to make sure that he had a financial cushion while also making the purchases that he needed to do so. There's three main kinds of financing. One's debt, which we talked about the most so far, and that's because it's the most common. And it's the lowest risk for investors. So in debt, the benefit is you get to maintain total ownership in your business. You're not giving any of that owner's equity up. But you do have to repay the loan with interest, and you are liable if for collateral repossession or garnished bank accounts and things like that if you don't actually repay the loan on time. Then there's equity. The advantage of equity is the money's in the bank. There's no repayment. If someone offers to give you $25,000 and your owner's equity on your balance sheet says that you're worth $50,000, that means you suddenly just have 50% more money than you had before, or 50% more assets than you had before, rather. But you do have to give up some ownership. $25,000 of the new total of $75,000 is 1/3 of your business. And that means that this new person who gave you that money towards this business now has 1/3 ownership in your business, which means that they get access to 1/3 of the earnings and could, through an LLC, an operating agreement or other means, potentially take over a little bit more control in the business than you might be able to do on your own. Third is gifts. The advantage, and this is true for crowdfunding type stuff like Kickstarter, Indiegogo, things like that. The advantage is you have no repayment and no loss of ownership. The challenge is it can take a lot of work to make a successful campaign in a very competitive environment with lots of other crowdfunding campaigns out there. So we're going to kind of go down through the basics of different types of financing that are out there. So savings. Savings is certainly the easiest thing to do. If you already have savings, you already have enough savings to start your business. Ideally, you've done it as a startup. If you're out there, I know many of you are just kind of starting up. You'll want to figure out all of your startup costs. What are the costs that go in? And that's basically the beginnings of a cash flow analysis. What are all the different costs going to go into leasing the land, getting the equipment together, starting yourself, making sure you have enough money to stay afloat personally, and figuring out if you have any savings to start that. Another option is friends and family. A lot of entrepreneurs depend on a small loan from their family like Rick did, or some assistance from friends in order to start their business. And certainly that can be a great way to go. It can often be more patient in the sense that they're not expecting automatic return on their investment. Also, it's important to remember in terms of gifts from friends and family, your family can give you up to $13,000 per year tax-free. But if they give you more than $13,000, then they get taxed on that by the federal government. So it's important to remember that when you think about the potential of doing a friends and family type gift. Then we have more traditional debt. Credit cards. The advantage is they're really easy to get. Pretty much anybody can get a credit card, and it can be a really easy way to be able to establish good credit history. They give you an easy monthly statement to show you how much money you owe. You have a defined upper limit. You have defined ways to be able to make payments, and it's a great way to build good credit. The challenge is that you can have really high interest rates if you have bad credit in particular. If you miss a payment, then your interest rates often go up, and there are often a lot of other late payment fees and things like that associated with it. So it's really best not to get into credit cards for making big purchases or to try and manage your whole season. There's a lot of like hidden fees and other things like that you should be watchful for. It's great to like kind of help you tide over during key moments or to make a couple purchases, but don't depend too much on them. Lines of credit don't come right away. They actually take a while to get. They're usually from banks or from other investment firms. And a line of credit is basically like an extra large size credit card. Fortunately, it's a much higher maximum level that you can borrow. Usually has a lower interest rate than a credit card would. It has defined repayments for how much you're supposed to repay at any one particular period over time. They usually do have penalties for early repayment because a lot of loans in general, as a backdrop, have penalties for early repayment. Basically, this just means that they're charging you because they want to make sure they get to maximize the interest rate on the principal that you owe them. And so they're going to charge you for early repayment. So it's something to remember. Also, just like credit cards, there's a lot of fees and other things like that you should be watchful for. Term loans or business loans are like the ones FarmLink does, 1 to 30 years long depending on the product. The advantage is it's a lump sum. You get an amortization schedule, they call it, that tells you the exact amount you're going to have to pay over time. It's a really simple process, which makes it really easy for you to know how much money you owe and how much you're going to have to pay. The challenges are there are some fees. For example, FarmLink has a 2% origination fee, which most term loan lenders have, which helps to pay for our processing. In addition to that, it's not like a line of credit or credit card where you get to keep borrowing money after you repay it. It's one lump sum, and then you're going to have to apply for another loan if you need more money. Online lenders and payday advance, please do not go there. There's legislation going through Congress right now because the industry is so corrupt. And there are so many hidden fees that you may not be aware of, and I just highly encourage you to figure out some way to manage yourself other than going to online and payday lenders. So alternative financing, there's a lot of different options out there. I'm only going to discuss a few of them because we could spend a whole hour and a half just getting into alternative financing. U.S. Farm Service Agency, I just want to mention, this is an organization within the USDA, and they provide a lot of great loan products. You can do direct loans for ownership and for operating of up to $300,000 at very low interest rates. And they also have a great down payment program where if you get a loan, for example, from FarmLink for 50% of the down payment of your ownership of your land, they'll put up $300,000 toward that at only 1.5% interest. So a really good rate overall. Generally, Farm Service Agency has a bit more paperwork requirements and reporting requirements than, for example, a nonprofit lender like FarmLink. Yet they can provide really, really great loan options for you and provide a lot of other amazing services. And we work with the Farm Service Agency in a lot of different capacities. And really, for example, they actually guarantee a lot of the loans that we provide to make sure that they're more stable. Kiva Zip crowd lending is an amazing tool. You can get loans of up to $10,000 for farmers the first time at 0% interest, up to $25,000 the second time, and thereafter at 0% interest after you repay the first one. Kiva really depends on character reference and a trust network of people to support you rather than looking at a credit score. And so for people with limited credit but who have a trusted network of supporters, this can be a great way to go. The idea is many lenders are providing small amounts of loan capital. We've seen lots of farmer success stories through Kiva Zip, so I highly encourage you to check it out. Ideally, you've got to have a few people who are willing to initially put in some of the micro lending, but then once those initial loans go in, then it goes live on the website, and there's tons of other people who can put money into making your 0% loan a reality. Certainly, it's 0%, which is a huge advantage over some other lenders. You're going to get less technical assistance to help you prepare for financing, to help you manage your income through an online site than you were going to get from a nonprofit like FarmLink or some other lender. But it's hard to be 0% interest for small purchases. So if you have a small project that you need to fund to make one purchase of an item, it's a great way to have 0% interest. Lastly, I'm just going to dive into crowdfunding, the crowd gifting, I call it. And that is Kickstarter, Barnraiser, Indiegogo. It's many people making small contributions to an interesting project. They usually require that they be projects. I think in the case of Indiegogo, it can be ongoing funding for day-to-day management. But in the case of Kickstarter and Barnraiser, it's usually for a specific project, which could be building a greenhouse or buying a tractor or one of those types of items. And the idea is that lots of people make very small contributions. They're not loans and they're not equity. So you don't have no repayment and you have no loss of ownership. Usually you have to provide them with small perks or prizes at the different levels that they donate at. And I just want to quickly mention that a great cross-marketing opportunity to get the prizes, rather than have to spend all of your time and money that you've raised through a Kickstarter campaign, then sending away all the prizes and buying them all. Find other entrepreneurs out there that share your values and get them to provide free product and then market those products as prizes. So they get the marketing advantage of being marketed to this large network of people, and you get the free product to pay off as your perks. So it's a cool way to do cross-marketing with other entrepreneurs. The real challenge, though, is that it takes a lot of work and time to do one of these campaigns in most cases. It really is a marketing and promotions campaign. So you really should be set up to develop a marketing campaign beforehand, and you have a defined amount of time to be able to generate this cash. In most cases, you have to get the whole sum or you get nothing. So it's important to remember it usually takes a lot more time promoting your Indiegogo campaign, for example, than you think it will. In addition to that, you really need a strong social media network of customers and supporters. You know, this is word of mouth marketing, and you need a big network who's passionate about you, who's then going to share it with all of their friends, who then share it with all of their friends. You really need to have a really cool story and a really strong set of supporters up front, and really the capacity on your team to actually run this kind of campaign. But if you do, it can be free money. So just quickly, as I said, as a lender, what we look for 2 to 3 years of experience in the business. We want to see a crop plan, if not a full business plan. We're going to want to see financial records. Certainly we're going to see your tax records and your bank statements, and we can, as FarmLink, in certain cases, help you develop the financial projections. We're going to want to figure out your overall collateral, which ideally is off-farm income, potentially also crop sale value, and also look at equipment and vehicles and real estate as ways to develop collateral to secure your loan. We're also going to run a credit report, which we'll share with you, and if there's problems, work with you to figure out ways to improve that. And it's important on the farm ownership side, as someone asked about, in many cases, lenders will only provide a loan as long as your lease agreement lasts. It's not true in all cases, especially if you've had leases that have been renewing for years with a certain landowner, but it is something that plays in. And we're going to want to look at references you have, character references from people you buy and sell to and your landlords. And then just how you communicate with us is very, very important. This gives you a sense of, again, some of the different loans that we have that are out there. We do have small starter loans. We also have our 1 year long operations production loans, our 1 to 7 year long equipment infrastructure loans, our mortgage loan product. And so there's a bunch of different ways that you could potentially seek financing through FarmLink if that was your goal. So that's all I have. Just remember, when you're thinking about borrowing money, think about the terms, think about the interest rates, think about the expectations and the relationship you have with those people and the benefits you're getting, and think about the plan B if you don't get it. And then also, just remember the benefits of thinking about your financing. You know, managing your cash flow, finding ways to invest in your business, and making wise financial decisions. But remember to do cash flow analysis and use other financial statements to make sure that you're picking the right financing at the right time.
Perfect. All right, we just have a moment left, but as we wrap up today, we'd like to take that moment to answer any final questions if there are any. So feel free to write in. And then we wanted you to just save the date for a follow-up webinar for this presentation, like we said, on whole farm revenue protection, that USDA program we were talking about earlier, crop insurance. And we'll send you a registration information about that next webinar in an email, as well as all of the different resources that Frederick mentioned during this presentation. You'll also get a recording of this presentation, and feel free to share it, post it or send it to your social network. We'd love for this information to get out and be widespread.
I'd also just like to mention, if there's a question you had that was not answered here, feel free to email me at frederick@cafarmlink.org.
Yeah, and it comes up on the next slide, and you'll be able to hyperlink it out of the recording of the presentation. We'll make sure it's in the email that you get as well. So thank you everybody for being on the line today. We appreciate your presence, and we also appreciate all the good questions and answers that came in, and we hope you have a beautiful day. Take care.
Thank you.